Hello and welcome to Boutiques Connect. Today I'm joined by Jarrod Cahn, Director at Credo Wealth. Welcome, Jarrod.
Hi, Chloe. How are you doing?
So, Jarrod, it's great to see you here again, and remind us briefly about Credo Wealth and who Credo Wealth actually are.
So Credo Wealth was formed just over 25 years ago by a group of expat South Africans, all who'd been living in the UK and had been working in the city. And they came together and they basically said they don't really like the culture of the city and they wanted to create something a little bit different. So they approached a few high net worth individuals, predominantly ex-South Africans, and created a boutique financial services group. And that was the genesis, effectively, of Credo as it is today. In the beginning, our client base was predominantly their friends and family and their network. So we have a very strong South African heritage. We have a strong South African client base, and that's basically been pushing forward and through over the last 25 years.
Thanks, Jarrod. So, Jarrod, you manage the BCI Credo Global Equity Fund, a ZAR-denominated unit trust here in South Africa, as well as its underlying Credo Global Equity Fund. So can you perhaps just take us through these funds and the investment process that you follow in managing them?
Sure. So the feeder fund, as it suggests, is a ZAR-denominated fund. So residents in South Africa have access to that fund in rands. They don't need to use their foreign exchange allowance. They don't need tax clearance. They don't need asset swaps. So it's quite useful as a South African investor to get offshore global hard currency exposure. The fund itself, the feeder fund, as you suggested, invests 100% in the Credo Global Equity Master Fund. And that is a large cap / mega cap fund that invests in developed global equities across the world.
So what is the investment philosophy that these funds are managed along?
Our investment philosophy is about 3 or 4 pronged. So first of all, we're long-term investors. When we talk about investment, we invest over a 3 to 5 year period. So we are proper investors, we're not speculators. Secondly, in terms of style, if you had to classify us, we would sit somewhere in the intersection between value and quality. And when we talk about value, we're not talking about deep value. We're not cigar butt investors, but we do like to buy high quality businesses, and that's where the qualitative part of the equation comes in. But we like to buy these businesses what we think is a discount to their intrinsic value.
So how have these fund sector allocations and positions changed since we last spoke?
So 2022 was actually a very good year for the Credo Global Equity Fund, given that our strategy is very much more value than it is growth or quality. And hence, although we lost money for clients, we outperformed our benchmark by 11.5%, and we performed very much in line with the value index. In terms of our sector allocation, where we did well, we were overweight financials. And when we talk about financials, it's not just banks. We have a broad tent of financials. So, under the hood of our investments, we have banks like Wells Fargo and JP Morgan. We have a plethora of insurance companies, from auto insurers like Progressive Group and Admiral to property and casualty companies like Chubb and Arch, specialty insurance, Beasley and Hiscox. And then we have also specialist financial companies like the brokers, Interactive Brokers, Chicago Mercantile Exchange, and IG Group. So although on the fact sheet, if you ever do look at it, you'll see that we had a 32% allocation to financials. When you actually break it down, it's a very diversified portfolio of stocks in that portfolio. And clearly what happened in 22 was interest rates started rising, and those assets, particularly the financials, performed very well for our portfolio. Outside of that, we also had quite a large overweight in healthcare, companies like Cigna Health, HCA, Bayer, and Humana, which also performed very well during the period, and also an overweight on energy, which certainly with the Ukraine invasion led to a bolster of the oil price, and we've remained very constructive on oil, and so holdings like Shell and BP have been good investments for us. And then lastly, I guess being underweight tech, just by the fact that we are more of a value strategy than a growth strategy, meant that we dodged a lot of bullets in the market last year and hence outperformed that way.
So Jarrod, you mentioned that you follow a value style on this fund. So how has it performed relative to the relevance index?
So we use the MSCI World as our benchmark index. Over the last year, we outperformed that handsomely. We were up 11.5%, or we outperformed by 11.5% against that index. Over a 5-year period, bearing in mind that for the first 4 years of that 5 years, it did favor growth as a style, we still managed to eke out a positive performance of just over 4% against the MSCI World. So we're very pleased with the performance of our fund over the last 5 years.
With regards to geographical exposures, Jarrod, how have these changed over the recent past, and where are you shifting allocations?
So given the nature of how we invest, we are very much bottom-up stock pickers. The stocks come to us in terms of screening and things like that, and then we look at an overlay in terms of where we are from a geographic point of view, currency point of view, sector point of view. But historically, we've tended to be pretty much in line with the US, so we've had 65 to 70% weighting in the US. But quite interestingly, during last year, we did go overweight the UK. So we went from about 15% to 25% of our fund in UK listed, but not necessarily UK exposed assets. And that's obviously because the market and the stocks that we picked were screening very cheaply. Most recently, we've bought a few European counters, stocks like Moncler and Kering in the luxury sector as a play on the China reopening and travel by the Chinese consumer. But generally, as I say, we have been overweight the US until fairly recently, where we've come down and exposed ourselves a little more to the UK and Europe.
So how are you looking to position the portfolio going ahead into 2023?
The portfolio is fairly well positioned from the point of view that we don't try and take macro bets. Obviously, we've benefited from inflation and a rising interest rate environment being in financials, and we understand that. We're also cognizant of the view that there is a potential pivot trade that will happen in the US, and that effectively means that growth assets, long duration assets, will get a short-term bump. We've reduced our financial exposure slightly from about 32 to 28%. But ultimately, the type of companies we own are long-term investments. And although growth may outperform in short-term periods, I think fundamentally things have changed for investors. The whole paradigm shift of cheap money has moved on, and the risk appetite has moved on. And so what you have now is stock picking, which definitely suits our type of strategy and our type of philosophy. So I think people have to concentrate far more on balance sheet strength, gearing, income statements, free cash flow, proper good quality analysis, as opposed to momentum trading, speculating, growth type of investing. And for that reason, irrespective of what the macro environment brings over the next 12 months or even the next 3 years, we are confident that the type of stocks we own through a cycle will perform very well. So as I say, we are very comfortable with our positioning right now, and we haven't had to make too many fundamental changes to the portfolio.
Jarrod, thank you very much for sharing your insights. We appreciate your time.
It's a pleasure. Nice to be here.